Hi, I'm Chris McHaney, Head of Investment Management and Strategy at Global X, and today I'm here with Brooke.
Hi, I'm Brooke Thackray, Research Analyst with Global X.
Today we wanted to discuss gold bullion and the prospects for gold in 2025. So Brooke, maybe the first thing I would ask you is, typically when I look at gold and what drives the gold price, there's three things. It's inflation concerns, or a weak US dollar, or a risk-off sort of environment. Now, I think what's interesting about gold is it's never all of those things. It's sometimes one, it's sometimes the other, and we don't necessarily know what's going to be the driver. How do you see that playing out in 2025? Is one of those three things going to be the main driver of gold price? Is there going to be something else? What are you looking at right now?
Well, I want to go back and take a look at what's been driving gold price right now, and then lead into 2025, because it's been a little bit different. We're seeing huge central bank buying of gold, and they're huge net buyers, and they've really been driving the price of gold over the last few years. If you go back and take a look at central banks, they were actually net sellers of gold from the late 1980s into 2009, and then became net buyers starting in 2010. And then you saw that huge jump up in 2022, where they set record amounts of buying, and that's continued into 2023. And central banks are price insensitive generally. They set a schedule and they say, this is what we want to do. We want to buy over this much time. And there just seems to be no abatement to that. They just keep buying right now. And I think that's helping to really drive the gold price at this time.
Do we think, Trump coming in the US with a second term there, he's talked about the BRICS, or he's almost warned the BRIC nations, stay away from creating a new global currency. Do you think this drive to de-dollarization continues, and is that going to continue to support gold?
Yeah, I do think that's going to continue. I mean, if we take a look, what we saw in 2022, all of a sudden the central banks start to really ramp up their buying of gold. And that was partly because of the US freezing Russia out of the SWIFT system, and also the result of the US printing money. They printed a lot of money. You go back and take a look through COVID. From February 2020 to February 2022, they increased their M2 money supply by 40%. So countries are going, well, do we really want to be using this currency if they're going to be just increasing money supply like that? And and we're also questioning whether we could be kicked out of SWIFT too. And so they started to move away and say, well, let's start buying some gold. I think that Trump has come out and said, you should be using the U.S. dollar as a currency. I don't think that's going to stop, though. I think we're still going to see de-dollarization. It's not going to be quite what we expect other people, what some people are expecting. I think it's going to be initially that you're going to find countries trading in their own currencies back and forth. They're going to start accumulating more gold, and maybe they'll start to make some sort of gold-backed currency down the road. But initially, it's going to be more trading with local currencies.
Makes sense. One other thing we get questions on is the difference between investing in gold, bullion, and gold miners. I don't know if you look at gold equities in general. Again, one of the reasons gold prices go up tends to be a risk-off environment, which means you wouldn't want equities in that environment. And so that's one thing I always have trouble wrapping my head around, is when do you buy gold versus gold equities?
I analyze that scenario by looking at the XAU, the Philadelphia Exchange Gold and Silver Index, versus gold bullion. And gold bullion has traded, traditionally from 2000 and, it's called 1984 into 2008, traded in a range of 4 to 6 times, up and down, up and down. A lot of traders actually traded that range. And because most investors just, as far as getting exposure to gold at the time, there was no ETF that had gold ETF, and so they bought gold stocks. And what you found was that ratio taking place. But once GLD came along, it came along in 2004. It was launched, the Spiders, State Street Spiders GLD gold ETF. After a few years, it became popular, and you found that the gold to XAU ratio, so gold miners, started to increase, and it went up a lot. So from 4 to 6, all of a sudden it jumped up, and it went up to, at one point, 25 in 2014. But it seems to have settled back down now, and there's a ratio that's taking place at a much higher level with gold because people are more comfortable with gold. And central banks aren't buying gold miners. They're buying gold. So that's what's driving the price right now. There's a place for both of them. in a portfolio. And a lot of people take a look at that gold to gold miners ratio and say, well, gold miners haven't done that well as gold. Well, that's because central banks have been buying gold, not gold miners. But I think down the road we could see some improvement with gold miners actually picking up in popularity because they are gold in the ground. There's political risk and operational risk as well. But there is a place in people's portfolio for that. I think the ideal environment for gold miners, as you said, you talked about, well, the stock market is partly related to that, is when gold price is going up and the stock market's going up. I think that's the best condition for gold miners.
Yeah, and so certainly growth potential from those gold equities and really gold bullion, more of that diversification benefit, a true diversifier to just a stock bond portfolio, difference of return stream completely there. Anything else we should highlight on gold that investors should consider?
Well, there's other ways you could invest in gold. I mean, you can buy individual stocks. You can buy an ETF that represents stocks. You can buy gold bullion. You can purchase some sort of ETF that's got a covered call overlay onto gold, which is a different type of investment, and it's in somebody else's portfolio a little bit different. Do you want to talk a little bit about that? Or?
Yeah, I think the covered call on gold bullion, as you mentioned, is an interesting way to create an income stream, right? Because obviously gold doesn't generate income. There's no cash flows or anything like that. And so for investors that may want that diversification benefit, want gold bullion in that portfolio, but at the same time, they're income-oriented investors. They want an income stream. They want something coming out of their investments. A covered call strategy on gold makes a lot of sense. Now, I think investors should understand with covered call strategies in general, you're trading away some of that upside potential in order to get that cash flow. So it's not as growthy as just pure gold bullion potentially could be, but it does provide that consistent income stream. So that's a great way to get income out of gold.
Yeah, and I think also as well, if your forecast is for gold to move slightly higher or meander around in a certain range, the covered call strategy can be a great option as well in a portfolio.
Okay, now that we've seen some of those drivers of the gold price 2024 and earlier, that central bank buying in particular, now we'll look towards 2025. What are the prospects for gold and what are those drivers going to be?
Yeah, we've seen some really strong performance from gold over the last year in 2024. It's been incredible, but I still think there's upside. I think, first of all, central banks are continuing to buy. China just announced after 7 months of taking a hiatus of gold buying from the PBOC, they've actually started to buy again. I think central banks are going to continue to buy. I think the same dynamics are taking place out there. We're still seeing that de-dollarization flow slowly over time. Surprisingly, we haven't really seen a lot of interest from investors actually buying gold in North America. It's been in the media a lot, gold reaching all-time highs. One of the ways I look at that is if you take a look at the State Street ETF, the gold ETF, GLD, and look at the inventory of gold ounces. Inventory of gold ounces has been moving down since 2020. So what that means is as gold price has been rising, investors have been net sellers of gold. This is an indication that we really haven't seen a lot of excitement as far as coming from retail investors or even institutional investors. It's a very small part of the portfolios. If we start to see some more interest in that, and I think that could happen as gold if it continues to go up, we could actually see a lot more upward pressure on the gold price as investors start to add more gold and gold ETFs into their portfolio as part of their overall portfolio.
So that's an interesting way to look at it, that the retail investor has not been driving the price of gold, at least recently. They've been net sellers of gold since 2020, as you say, or approximately 2020. And so that could potentially provide another leg of demand should that retail investor enter back into the market and become a net buyer again of gold. So maybe one reason that retail investor hasn't been a buyer of gold is gold reaching all-time highs in terms of that gold price per ounce, potentially scaring some investors away. Maybe they think they missed the boat. Of course, I think it's important to point out, and a lot of people do, that the inflation-adjusted price of gold certainly isn't at all-time highs yet. We can go back to 1980 and inflation adjusts those prices, and we're getting to somewhere around $3,000, I believe, for an ounce of gold. So potentially still a lot of upside left in the price of gold that, again, could potentially bring that retail investor back in as a net buyer. Do you look at gold price prices in that way, such as here's the all-time high, therefore it can't get past that again, or here's low prices, it's not going to go below that again? Or is it potentially just an all-new path going forward?
Well, I think you can use technical analysis to help provide some short-term benefits as far as that goes. But gold is actually, on a technical basis, actually produced a cup and handle, which has actually been a positive technical development, and it's broken above that last part, which is the handle. So technically, that's actually a good thing. But I think the fundamentals driving gold right now are quite strong, and we can, once we reach a certain point, the all-time high, even if it's inflation adjusted, I think we can go through that because we've got a lot of positive fundamentals supporting that. And if we want to take a look at perhaps where we could go with gold and how long a gold rally could last, interest rates is one of the factors that does drive the price of gold, because there's an opportunity cost of holding gold, and the lower the real interest rates, then the better off the gold looks as far for investors. But one of the ways I look at it is, if you take a look at the gold price around when the Federal Reserve starts to cut its federal funds rate, and take a look at the 2-year yield when it starts to go down, so when the 2-year yield's falling down on a major trend, gold actually does quite well until the bottom, when the 2-year actually bottoms out and heads higher. And so we saw that from in 2000 to 2023, when the Federal Reserve cut their rates in 2000, 2-year peaked, and then 2023, the 2-year yield bottom. We saw positive development there, just as we saw from 2006 to 2011, and also from 2018 to 2021. So in all three of those cases, we saw the 2-year yield higher after the Fed had paused, and with the 2-year yield headed lower, I should say, and gold actually did extremely well in those circumstances. Now, the Federal Reserve has paused its rate hike back in July of 2023, and we saw the 2-year yield peak in October of 2023. So here we are, just over a year. We could have another few years of the 2-year yield heading down and gold doing well if we'd look at the past scenarios.
So we have declining interest rates, which could be bullish. We have that central bank buying that's going to continue. That puts a floor as well on that demand. And we have geopolitical risk, I think, is continuing. And that's, again, something that causes investors to look towards gold, that instability globally. And I think that continues to play out over the next year as well. And so potentially another support for the price of gold, and can lead into that sort of bullish scenario, I think.
Absolutely. No, I totally agree. I think if we look at all the factors involved, I think gold has a positive outlook going forward. Now, maybe volatile going forward, and we could see some ups and downs, but the long-term prospects are well placed for gold to do well. I think gold can do well once again in 2025.
What do you guys think? Let us know your thoughts on where gold's going to go in 2025.